Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and I'm here with my buddy Danny Romberg. We did a video, what was it, like 8 months ago, talking about where Index Universal Life actually works. If you watch this channel, it's no surprise to you. I do a lot of education around Index Universal Life. The ironic part about Danny and my relationship is he sells a lot of Index Universal Life, and he's one of what I would call the good guys that does it right. There are ways, I always kind of say, there are situations where Index Universal Life can work, and Danny focuses on those areas. And so last time we did this video on how, where does Index Universal Life work? And Danny was like, Chris, let's do a video called Where Would It Work Part 2, because there's some other areas and some ways that I've been doing. Definitely. And so I'm gonna be fully transparent. He started telling me some of the ideas and I was like, no, let's just do this on video because this is gonna be fun and I wanna keep this authentic and real. And I'm not even sure that I agree with him yet. Right. We're just gonna figure this out. We're gonna have a conversation around it and go from there. How's that sound?
That sounds great.
Awesome.
It did take a little bit of convincing to get here, but but I really think we need to make this video, Chris, because there is a space out there where Index Universal Life can work to serve people. And my mission is to help bring awareness to where people can create some discernment and try to figure out where does this product actually fit and how does it help people. Now, at the end of the day, I don't care if it's Index Universal Life or Whole Life. I know we've talked about this before. I care about what are the client's needs, what are the risks we're trying to eliminate, and where can we serve people, and then what fits into that, right? And where I've found a void where I think we could really spend a little bit more time talking about is actually in retirement.
Yeah, sure.
So I feel like Life 180 does an incredible job of talking about the accumulation, the preparation phase of funding life insurance. And that's not the phase I'm going to talk about today. I'm talking about in retirement where it fits. So the majority of my clients are in their 60s, 70s, 80s, even 90s. And Index Universal Life, believe it or not, has a really cool use case in some of those applications. Now, not for the 90-year-olds, but when you're talking about 70-year-olds and 80-year-olds, there is a really cool strategy that you can actually use Index Universal Life and take qualified money, an IRA, and there's actually companies and products out there that you can transfer the IRA to the insurance company and systematically pay into Index Universal Life purely for the death benefit.
Okay.
So we're not talking about cash value accumulation.
All right, so when we're talking about utilizing it in retirement, I'm going to be really, really clear on this.
Please do.
Because a lot of people are out there trying to tell you tax-free income in retirement is the best way to use it for retirement. That is when I have a problem with Index Universal Life, it's because of the fact that people are buying it as a retirement income alternative vehicle, right? And that's where 99% of the policies in this industry are sold with IUL, and that's where it ironically is the worst use case of IUL.
There's a lot of challenges,
and problematic. What you are talking about is not using it for income at all.
No.
It's strictly death benefit.
Strictly death benefit.
Strictly from a legacy perspective.
Strictly from a legacy perspective and strictly living benefits from the death benefit. Accelerated death benefits from that death benefit to pay you if you have a qualifying care event. But thank you for making that distinction, because when we talk retirement, a lot of people do think retirement income.
Yeah, for sure.
We're not talking about retirement income. We're talking about legacy and wealth transfer.
You have a lot more needs in retirement than just retirement income.
Of course, yes, exactly.
Probably more than ever in your life before.
Oh, absolutely, right. I mean, there's a ton of risks to mitigate in retirement. And so retirement income is the first one we start with. Obviously, you need to have that to retire, but then we look at what are the other key risks, right? This is Tom Hagner's philosophy. We've used it for 10 years. It's absolutely a great way to systematically go through and figure out what you need. But where this has a lot of value is not for taking tax-free loans or trying to accumulate the cash value at all. But there are really unique strategies where you can help somebody who says, hey, I have this IRA, I take a required minimum distribution because I have to, but I really would like this to be a tax-free benefit to my family one day if I don't spend it all. And in fact, Chris, we've been talking to our clients. It's about 70% of our clients would not take their RMD if they didn't have to.
70%?
70%.
Can you explain to people what the RMD is?
Absolutely. So once you get to a certain age and you have a retirement account, this would be a 401k, a 403b, a 457, an IRA, once you reach certain ages, and it just changed this year with different ages where you start taking it. It used to be 70 and a half forever, then they moved to 72, now it's 73 for some people, and even 75. Once you hit these thresholds, depending on when your birthday is, the government, the IRS, makes you take a required minimum distribution. So every year you have to take a percentage out of that IRA. So what happens is you have a lot of people in retirement who have been retired for 5 or 10 years, have figured out how to live on their retirement income. They didn't need this RMD, but the government makes them take it to satisfy the requirement of getting that tax deferral throughout their whole life. So what happens is that creates a really unique opportunity. And when we talk about whole life, I like to think of it in the earlier ages, the 30s, the 40s, the 50s, even 60s. But when you get into your 70s, that RMD that comes out every year, that really creates an opportunity for somebody to reevaluate what they want to be doing with their retirement account.
Yeah, because chances are if they haven't tapped into it and they're just doing it because of the RMD, they don't need that money. They're just forced to do something they don't want to do.
Right.
So why not take that money and leverage it to create leverage and create more of a legacy play or create more of a living benefit protection or some other, as long as there are guarantees behind it, right?
That's the key.
So this is where, and this is why I love Danny, because most IUL agents say, oh, don't even look at the guaranteed column, right? Because
it's terrible.
And then they try to justify all the reasons why the guarantees in the IUL contract don't matter.
Yeah.
And honestly, I don't want to sound extreme. I agree with most of the reasoning on why guarantees don't matter, even in an IUL contract, at least early in the contract for people. However, for what we're talking about, if you're going to be putting money, if you're 50 plus and you're putting money into an IUL, those guarantees matter.
Matter a lot.
They matter a lot. And
Definitely.
with any life insurance policy.
Yeah.
And so talk to me about the guarantees and kind of your process in finding the policies that work.
Yeah. So we have a couple things there that I want to unpack. So first of all, we really have a tough time trying to make sure that people understand that there's two different ways we're talking about using IUL. There's the accumulation, tax-free loan. We are not talking about that at all, right? That's not what we're focused on, and I don't use it that way.
Right.
I'm talking about for specific retirement risks that you could solve using the death benefit and the accelerated death benefit. I'm not even focusing on the cash
So
value.
wait, you're using IUL as insurance?
As insurance.
It's interesting.
Well,
okay.
that's what it is.
So you're, okay.
So, but again, it has to have that strong guarantee from the company.
Yeah.
If it doesn't, you can't use it at that age. And those ages is too much risk. I feel that way. Now, I don't want to make any give any opinions here, but I feel like for me personally, if you do not have that strong guarantee column, it's too much risk.
Sounds like you just gave an opinion.
So let me continue on that
go
if
ahead.
I can.
Okay, go ahead.
So we're trying to distinguish where it can be used, and it has to have that strong guarantee. So for people who have IRAs in retirement, okay, we ask all of our clients, would you take your RMD if you didn't have to? 70% of them say, no, I wouldn't. Guess how many people tell me that it is, but guess how many of my clients have told me that if they didn't spend all their money in their life, they want their kids to pay taxes on their IRA? Zero. 100% of the time they tell me, is there something we can do?
Yeah.
And so an IUL has the ability, and some companies even build it all into one product where you can transfer the IRA.
My stomach is turning even listening, but I'm hearing.
But they will help the client to make payments out of a single premium immediate annuity into an IUL contract.
So you use a SPIA.
Yeah, but they do it all internally.
Yeah. Okay.
So it's really special for somebody who has this need. They go, I don't need this asset. I'd love it to be more tax favorable to my kids so they could use it immediately.
Yep.
What could we do? And so the company will help to spread out the tax expense, pay into the IUL over 10 years.
Okay.
And it has a very strong, from the illustration, a strong guarantee from the company that they will get that death benefit and that living benefit for the client if they need it first.
So you're not selling it based on upside potential and downside protection and accumulation and distribution and all that stuff. You're selling it basically saying, hey, you're in retirement, you have whatever income that you have going on, and you're set financially. Yeah. But you have a legacy need, and you probably have a living benefits need, we'll just call it, and maybe you want to have more control over your medical directive, a little more flexibility, long-term care kind of stuff, like any of that kind of stuff going on, right?
That's who it's for.
Right.
Yeah.
And so if that's you, and honestly, now we're talking about a more affluent segment of the market than most of the people that are buying IULs for accumulation, thinking they're going to avoid their 401k and all that stuff, the way that most people are selling.
Yeah,
right?
We're not talking about that at all, right? We're talking about people in retirement.
No, I'm just doubling down and making
triple
sure
down.
really,
I want to make
really
sure
clear
people
on,
understand
on what's happening.
And that's
here.
my mission. I want to help consumers, because so many people are coming to me, Chris, going, somebody showed me an IUL, somebody showed me a whole, and I'm going, let's focus on what are your needs? What do we need to have happen here? And let's go from there. So I want to help consumers who are watching these videos understand how they can start to put these pieces where they fit, and they can get a guide, right? That's really important. And so I want to focus on the decumulation phase. I'm not talking about the distribution phase, right? When you're in retirement and not using IUL for that, using IUL to help with those other key retirement risks. What happens if you pass away? What happens if you get sick?
So it's interesting, and I want to touch on this for a second. I just so you love IUL for the right use case. I haven't sold an IUL in almost a decade now.
Yeah.
You like IUL for the right use case, but you would never sell an IUL for accumulation and distribution and the way that people are doing it.
I don't, no.
Okay.
I do not. Early on in my career, when I was starting out, learning the business and learning IULs, I bought some IULs for that case.
Oh, so did I.
Yeah,
for that.
I mean, we all started in
we
that.
all make mistakes.
This is like therapy. No, but I bought some for myself. I bought some for my wife, and I was excited about it. But then, you spend time really when the students of this business, the people that are going to be here for a while, that want to make it and want to make an impact and do it the right way, and thanks to a lot of time we've spent together, and I wouldn't use it in that circumstance personally.
But when it comes, okay. So what I'm hearing, I want to recap this just so everybody watching, we can kind of land the plane here on this a little bit. So if you have the place that this works, and I'm going to just talk to a consumer, somebody, if you are watching this video and you're thinking, is IUL right for me in my situation? The answer is, if you're in your 60s or 70s, I think maybe even 50s in this situation, or probably, but ultimately you're talking about RMDs, so
that's
in
70s.
The 70s,
that's
we're
70s,
talking. But it can work in the 60s too, if anybody over 59 and a half, ultimately
it's 60 and up.
60 and up.
Yeah,
60
because
and up.
when I write an IUL, I'm doing one of two things. This is all I do. I either MEC it, so I have somebody put in a lump sum, and again, it's got strong guarantees through the return of premium rider to make sure they can take all their money right back out if they want.
Okay.
That's the only time I'm writing an IUL with an accumulation cash value design. Strong return of premium riders, strong waiver of surrender riders.
Okay.
Otherwise, I'm using it for the death benefit only.
Okay.
Which I feel like is how it should be used.
So most people think of life insurance, whole life and IUL alike. They think of MECs being like a 4-letter word.
Right.
So explain and just dive deeper into that, because if people are watching this video and they're now we've obviously confused some people, right? Because they're like, wait, Chris always says IULs are bad. Now he's saying that there is a use case, and now he's saying you can MEC them. And now what the heck? Now everybody else says MECs are bad, and now people's heads are about to explode.
Right. So that's why we're making this video, because it's hard for consumers. How do you understand all this stuff, right? There's agents that don't understand all this stuff. So we want to make some parameters for people to use. Say, okay, where could this fit for me? Okay, and I wouldn't say I love IUL and I use it all the time in these cases. I use whole life in those cases too. There's great whole life products. It totally depends on what's in the client's best interest. You gotta check it.
You can compare them side by side, right? Run it on both and see which one is better.
We do all the time.
Totally.
And that's how we make decisions. We try to help show people and educate people. But when we're talking about the education process, right, there's a lot of misinformation. And so people are watching these videos, they're going, wait, MEC's bad. They're trying to create parameters in their minds so they can make good decisions, right? MEC's bad, MEC's good. IUL, whole life, right? It totally depends on what phase of life you're in and how you need to use the policy.
What problems do you want that policy to solve?
What do you want it to solve, right? For me, when I buy policies now, I'm buying whole life in my phase of life because I want to have the ability to use that cash value, and I want it to be there, right? And I want it to be available soon. So for me, I like that in that phase. But for my clients who are mostly in retirement, I can't put myself in my client's position. I got to take it from their perspective, right? So they have different problems and needs that I have. I'm not accumulating cash values for people in their 70s. They're focused on, hey, how can I make sure this IRA or this taxable money is more efficient for my family? How can I make sure that if I need this money for care, it's actually positioned for me to use for care?
Yeah.
Not in a fully taxable account that might have expensive, taxes to take money out, right? This is a different phase of life. These are different problems and needs we're trying to solve. So when we get back to the MEC and how that's used, first of all, the reason why I use it 60 and up is because there's penalties. If you set up a MEC before age 59 and a half and you take money out, there's a penalty on that 10% penalty.
Yep.
So we're not using it for anybody under age 60. But if you're 60 and up and you have a potential need for wealth transfer, a potential need for income replacement if one spouse predeceases the other, or a potential need for care, that MEC is strong. And you can put money in one lump sum. It'll get a death benefit. It'll get a care benefit that you can attach to it through a living benefit rider.
Yeah.
And you can really remove a lot of these key risks and give people some control and some safety that they want.
All right, so the next thing.
The second thing.
I
I haven't gotten to that yet.
Go ahead.
So the other way I use IUL in retirement is for somebody who wants to get a strong guarantee from a company that they'll have a death benefit.
Wait, guarantees inside of an IUL?
Yes.
Okay, keep going.
So, so a lot of people like term because it's pretty straightforward, right? You pay this premium, you get this death benefit. That's it.
Yep.
But it's only for a term. It's gonna lapse.
Period of time.
It's gonna go away before you probably end up needing it, right?
Sure.
Like 99% of the time is the statistic,
Yep.
right? So this is where IULs with strong guarantees fall into the equation because there's people in retirement, Chris, who tell me, man, what could I do? Like they're very worried about their spouse.
Of course.
If I pass away, my pension goes away, my annuity goes away.
You mean Dave Ramsey's plan of just getting there and being fully self-insured and whatever that doesn't
well, that's
work?
a whole other video.
Oh, okay.
but like if you have a married couple and if one of them were to pass away, there's significant lifestyle reduction in risk to that other person.
Yeah.
That's where insurance can really solve that risk. You can just protect them. And so you can use an IUL that has a strong guaranteed column to go to a certain age where they're going to be able to have that protection. And I think it does offer a lot of value there. And it also offers a lot of value for living benefits,
Do you MEC those too?
No, those are annual pay policies.
Those are just annual pay
But again,
policies?
if it accumulates and builds, that's a bonus. We just want the guaranteed column.
So that's the upside potential, downside protection. You're looking first and foremost, like I always kind of use the analogy, like what's the upside, what's the downside, can I live with the downside?
Yeah.
You're looking at the guarantees is, all right, downside, can you live with that? Is that good?
Yeah.
Like, is that going to solve your needs on a guaranteed basis? Downside, worst case scenario, life insurance companies there, like boom, that's that. The upside potential is maybe you'll get some accumulation out of this thing, but like, whether you do or don't, it's almost inconsequential to the conversation.
Let me give you an
Fair
example.
enough?
Perfect.
Okay.
And in fact, let me just touch on one more thing before I go.
Okay.
So when you mentioned earlier how some agents, I'm not going to call anybody out, but they cover up the guaranteed column and they say, look at this good column, right?
Can I call some people out? No, I'm just...
I do the opposite with mine.
Yeah.
I cover up the performance column, and
That's why I like you.
And I go, look at the guarantee.
Yeah,
if you like this will be. I don't cover it up for real, but I mean, it's just there.
But I don't draw attention.
I don't use it for saying, hey, this is what it'll do or what it could do. I'm looking in my cases on that guarantee, on the illustration, and if that looks good, then we can use it.
Well, and that's just good business too, because you're never going to have to, like one of the things I always kind of use as a story to tell people why I switched from selling IUL to switching to whole life is because I got tired of having to tell my clients that I was sorry. And so that was a big thing moving forward is that, I never wanted to have to tell another person that I was sorry in this business. And if you go about it from that perspective, which that's exactly what you're doing. I mean, you're not doing it with that mindset necessarily, but I know you and I know in your heart, like that's kind of where it's coming from.
Yeah.
And that's a big thing. Like, and if you sell IUL from that perspective, just focused on the guarantees, expectations and planning and everything is very clearly set. They are very aware of the role of this asset in their life, because make no mistake about it, it's an insurance policy, but it's guaranteed to be there. And it's guaranteed that as long as you follow your contractual obligation, it's there and it's gonna fill a need. Therefore, to me, that's an asset, not a liability of an insurance policy, right?
I don't want that. Yeah, I don't want to ever apologize to anybody. And when you use the guarantees, you don't have to,
right?
Because it's just the insurance company saying, here, this is what we're willing to guarantee.
Yeah. Yeah,
so I think that's important. And again, what I want people to really hear is, I'm helping people who are above age 60 with this, who have very specific retirement risks. Let's go back to that 70-year-old real quick. They're taking let's say they're 73 because they're taking RMDs, right? And they say, I wouldn't take this RMD if I didn't need it, but I would love for my beneficiaries to receive this in a more tax favorable way. I would love to protect my spouse. I would love to add some care benefits so that if I did need care, I don't have to drain my assets. I can actually have a buffer that will pay me the right amount of money I need tax-free to cover my care need and make sure I can stay comfortable and preserve the legacy I wanted. That's where I'm using.
Sounds like it could be really powerful in like a really elaborate estate planning situation too. Like I mean,
I'm sure it has use cases there too, where people can use it to,
Yeah, that's interesting. Well, so all right, so just to be clear, not traditional, not your tax-free income at retirement.
Right.
We're talking about 60 and up, a MEC that's optimized, and and he's got ways to do it. If you want to talk to him about it, reach out to him.
Yeah.
I'll put his contact information below. Or another way is and just look at the guarantees behind the policy.
Yeah,
right?
You're just buying it for insurance. Like I'm buying a death benefit, and I want it to be
death benefit
there.
and living benefits.
Death benefit and living benefits.
Not income.
No, that's not what I'm using it for.
Okay.
Yeah.
Everybody clear?
Just to be clear.
Everybody clear?
And Chris, I want to say thank you for letting me make this video with you because I was like nervous coming in today. Will Chris be cool with this video? But I think it really shows a lot of your integrity to have me on and talk about this because there are use cases for it, but very specific cases where it actually can serve people really well.
Listen, a lot of people think that I am very focused on hating IUL. I don't hate IUL. I just try to share my experience and knowledge about it and educate people because of how I think it's so misrepresented. I think what you're doing with this is how the intended use of the product was actually created in the first place.
Oh, thank you.
And I always kind of say there's definitely situations that it can work. The problem is that's not how it's being sold to most people because it's not the easiest. It's not the easiest sale unless you have the network in the market, to sell to. And most people are out there selling IUL are selling it to young families and like all these people for completely different reasons. And it's, that's a whole nother conversation, but it's, that's the problem with it. And so, I always tell people one of the biggest problems in this business and that I run across is that we have too much confirmation bias. Too many people trying to like not want to seek the truth on the other side because we just, if we had that truth like awakening, so to speak, then it's gonna force us to have a lot of really hard conversations with people that we've sold stuff to. It's gonna force us to maybe make some big changes in our own business and practice, and it might hurt your profitability. And trust me, I get it. A lot of people that think that I haven't gone through that and that I just love to hate on IUL for the sake of it. No, I went through this process and I had to have those hard conversations and I had to lose a lot of money and walk away from a lot of income to make this transition. Ask my wife, it was a really rough kind of couple of years when I made the transition, but like, that's why I have people like you on to do this because you're challenging my perspective. You're out there on the front lines, serving people and helping people do this. I know and trust that you're doing it with full integrity. So when you say, hey, Chris, I think you're missing something, like I go, I don't know, Danny, like, whatever, but I'm willing to hear you out. And so, but I will say this, I haven't done a deep dive in it.
Sure.
So just so everybody's, fully transparent, but I will say this, that if Danny is saying this, I trust him. Like he's not gonna BS me on this stuff and come on here and I know he's never going to put anybody in a situation that's not in their best interest.
100%.
And so from that perspective, that's why I feel comfortable doing this video with you basically live. I mean, this is going to be not edited. It's not going to be like whatever. I know we're not live right now, but effectively this is going to be live, there's no cuts or no nothing, right? Like, and we didn't prep for this. This is just totally winging it.
No, I just wanted to bring this in. And my mission with this was like, I don't believe there's any good or bad. They're tools. And you got to use them for what they're designed to be used for, right? They're designed, they really work well in this one space. And I want to give consumers a really good chance to make sure they're making good decisions. Yeah,
it's not good or bad in general. Is it good or bad for you and your circumstances and the problems that you're looking to solve? And like, does it have the attributes and provide the solutions that you need?
Yeah,
right. That's
it
what
just comes down to use them what they're designed for.
All right, guys. Well, so if you have any questions, I would say comment in the comment section below. Let us know if this is valuable to you in any way. Just leave a comment on what your thoughts are. If you haven't already, like the video, share the video. Get this to all the IUL agents out there that that think I just hate IUL constantly. I promise you, I am trying to get this information out there in a good way, and that's why I bring people like Danny on. This is amazing. Thanks for being here.
Yeah, thanks for having me. Thanks for
guys, if you haven't, I'm also going to put a link to Danny's channel. Go down, follow him. He's also putting a lot of time and energy into creating his own content. I see you're doing a lot of shorts and
we do a lot of shorts.
Doing a lot of a couple videos a week kind of deal.
Yeah.
But he's got a great perspective. Go check his channel out as well. I'll put his link to his channel down below. And that's it. Until next video. Have a blessed, inspirational day. We'll talk soon. See ya.